Yo, what's going on, guys? I'm going to quickly teach you what a mitigation block is, and in a separate video I'm going to kind of go over the difference between a mitigation and breaker block. So a few videos ago I posted what a breaker block was. So basically what a mitigation block is a mitigation block does not take liquidity. So what does that mean? What this means is, see how this green candle before the down move is formed here? And this, in this situation, this would be an order block, okay? We get up here, we reject it, we get up here, we reject it. So every single time it's rejected at first, okay? But what happens when we break above it? So when we break above this zone, right on this candle, you can see we come down, retest it, and then we hit the price target, okay? This would be sell side right there. But why is this mitigation block? Well, after forming the green candle, we do not hit. There's no form of liquidity down here to hit, okay? The next liquidity would be right here. But as you can see, we never come down and hit that. So that's why this would be a mitigation block and not a breaker block, okay? And what happens is, because this doesn't take liquidity, we would, like, no matter what, every single time we come up and break this to the upside, then yeah, this would be a mitigation. You look for the retest, and your target would be the last swing higher, last swing low before we went back to the mitigation block. So in this case, we make a high right there, hit the mitigation block, boom, this is your target. And obviously, if you had a bullish bias, you would obviously have other targets too, but you could just find this in the middle setup. So another example would be something like this. So in this, we have a green candle before a down move, so you go, woo, and then huge pump, okay? And this was at market open. And the reason why I use this candle is not this candle, because this is the start of this move on a bigger, kind of in a bigger time frame. It's not going to go like this on this. If I go to the 50 minute, it's just going to go straight down, probably like in a more linear line. So obviously in the smaller time frame, there's a little bit of curve. But after, when we create this green candle, you can see this is the next form of liquidity. Okay, down here we never take liquidity, and then we kind of pump back over it, and you can see, when we get back down to it, we make a nice almost 20-point move off of it. So you can see we made a nice 20-point move. We hit liquidity, which would, like, this would be your first target, obviously. This would be your second, third, and so on. All the swing highs would be your targets, but we'd hit the targets. And for the last example, it would be this, okay? So this is a red candle before a move up, okay? And what you see here is we do not take liquidity. If we took liquidity, we'd have to break these highs, okay? Or even this high. And you can see we reject right before it. So this is why this should be considered a mitigation block. And once we go through this mitigation block and come back up to it, we're rejected a ton. And the important things with taking these mitigation blocks and breaker blocks is you want to see it in the middle of a fair value gap. So this is in the middle of a fair value gap. As you can see, the fair value gap is this size, like this. So it's in the middle of a fair value gap, and those are the most high probability times you're going to want to take these mitigation and breaker block setups. Again, I'll make another video that goes over the kind of the difference between them, but a mitigation one does not take liquidity. So when this red candle is formed, this does not take this high. It tries to, but it gets rejected before. But it's still kind of an example of the same block. Even if this did take the high, you'd still take the same setup, okay? You'd still look for a rejection right here with a breaker block. But for terms wise, this would be a mitigation and not a breaker. So that's kind of something to note. And yeah, so other than that, I'm gonna make this video is very short. So other than that, I'm gonna make another video that kind of goes over the difference between them, like side by side. I'll probably pull up another thing. But those were 3 solid examples of mitigation blocks. None hit liquidity after the block. They all rejected before hitting liquidity. Go back up to them, retest, and boom, we don't hit it. And the final key point I want to make is make sure they're all in fair value gaps, okay? Obviously, these are not going to be in fair value gaps sometimes. The most high probability ones will always be in fair value gaps, so those are the ones you want to take. So if you're ever looking to take a fair value gap, look to the left side of your chart, see if there's any of these failed order blocks. So obviously this was an order block before because it's a red candle before a down move, and we cut right through it. So that's why it would be a mitigation block now, because we didn't take liquidity. It was an old order block and we cut through it. So yeah, hopefully you guys learned something from this. Let me know if you have any more questions in my Discord. I can help you there. A lot of these setups are like, you're gonna have to be patient to find these, like very, very patient. This was a mitigation block, so see this red candle right here before this up move? We never took liquidity. See how we never took liquidity? Yeah, we made a huge move down, and next time we came up here, we rejected it. And why is this so high probability? Because we're in the middle of a fair value gap, and it's a mitigation block right there. So, yeah, hopefully this helped you guys a little bit. Another thing you could kind of keep note of is if it's a discount or premium, and obviously if you draw the fib from here to down here, this is way in premium, so this was a good time to short, obviously. The most high probability ones will be during New Year kill zone, so like in the new 8:30 a.m. Eastern to 12 p.m. Eastern, 1:30 Eastern to 4 p.m. Eastern. They're going to be in discount or premium. So again, if you're shorting, you want it to be in premium. If you're long, you want it to be in discount, so under the 50% fib, premium above. And another high probability trade will be they have to be in the fair value gap. So those three things, if you just wait for those three things to match up, you'll have a very high win rate. But again, you have to be patient. Mitigation blocks, remember, they do not take liquidity, okay? Breaker blocks do. So if this went above this high and then retraced, then yes, this would be a breaker block. But it's a mitigation block because it didn't take liquidity. So hopefully you guys learned something. Let me know if you have any questions. And yeah, peace.